Welcome to our discussion on financial literacy. This is mostly just a lot of vocabulary, so feel free to ignore it and just go read the book if you want to. All right, let's go through some of these things. A PE ratio, right, is just the ratio of the price per share to the earnings per share of a stock in a company. And that's good to know if you want to, look at stock reports and figure out how stocks are doing. What is a stock? If you don't know what that is, it's a portion of a company that you can purchase. So a company goes public and it sells shares, right? And you buy those shares and they're called stocks. So shares are how many pieces basically the company is divided into. The profits that you get from owning this company, those are called dividends. So it's just a fancy word for profits. And then everybody should know what a retirement plan is. It's just basically figuring out how much money you can invest in certain things, kind of like a future savings plan. So when you stop working and you no longer have a steady income from a job, that you still have some sort of money coming in from this retirement plan, these savings. Okay, most companies will report their earnings every quarter, i.e. every 3 years, quarter of a year, so 1/4 of 12 months is every 3 months. And their earnings, again, is just another word for profits. And then they'll take that all that money that they earn. So hopefully, if they had a profit, they'll take those earnings and they'll divide it by the total number of shares that they have, right? That they've basically cut their company up into, and that'll be their earnings per share. So in a very basic sense, let's say you have a very small company that only has 1,000 shares. If at the end of the year, your small company had a profit of only $5,000, right? After it paid all of its bills and paid all of its employees and all of its expenses, it made a profit of 5,000. You would take that 5,000, you would divide it by the 1,000 shares that you have, that the company is made up of. And each share, the earnings per share was $5 per share. So anybody who owned a stock, a share in that company, they just made $5 that year. If they had one stock, and if they had two stocks, they made $10. And that's pretty much how it works. Okay, so another a little bit more realistic example, we can say that for AT&T, the earnings per share for 2010 was $3.55. So for every share you owned, you would get $3.55 basically in profit. So let's see if we can compute the PE ratio. And remember, the PE ratio is price per share um, compared to earnings per share. That's the PE, price to earning. That's what so to help you remind, PE is price to earnings. So here's our price to earnings. So we can figure out that ratio, right, by doing what we've been doing all before and do this number over that number as a fraction, which is going to turn it to something over 1. So basically, if you just do the math and get the number, that's an 8 to 1. So price per share basically means for every so if it's 8 to 1, that means for every $8 in value of your share, it earned $1, right? So 28.44, if you divide that by 8, it happened 3.55 times, right? Every $8 price of the share earned $1 in earnings. Doesn't sound very good, right? It'd be nice if it was the other way around. All right, so here are some examples of stock quotes. This isn't a video on the stock market, so I'm not going to spend a lot of time on it, but it'd be nice if you were familiar with some of the basics if you do ever want to invest in stocks, right? So obviously, the name of the stock, right? It's on the New York Stock Exchange. Here's the current price. The change of 0.17 means that's how much it went down. It went down, or sorry, it went up by 17 cents, which represents a 0.6% increase. If you do 0.17 divided by that, you'll see that it's 0.006 or 0.6%. So it's gone up by 0.6%. The volume, that's how many shares are trading at the time. The day's range just means that in the last 24 hours, the lowest price that this thing was trading at was 28.23 and the highest was 28.48. Same thing for over 52. So over the last year, this is the range. The 1 year percent change. So from 1 year ago to today, it's gone up $10.66 in the last 12 months. Pretty good. Beta, I have no idea what that means. Price to earnings, that's your PE ratio, right? So the price earnings is your PE ratio, and we saw that it was 8 from the previous page. earnings per share, we also saw that from the previous page, $3.55. And then dividend and yield is $1.72 or 6.06%. Now, a dividend just means the money per share profit. So this dividend means that every share earned $1.72 in profit. So that's based on total profit divided by total shares. And then this percentage, that's your dividend yield, and that's simply just that same idea but as a percentage. So instead of saying we earned $1.72 per share, this is the percentage of the current share price. So whatever the profit was, or whatever, sorry, so the profits are divided by it, but whatever the current share price is, your kind of yearly dividends. So the dividends, you made 6.06%. That's basically what it's saying. So it's gone up by 6.06% total, and that's your total profit for usually for the year. These things are normally reported for the year. Sometimes they can be reported for the quarter. Just depends. And then here's just another moment in time, right? So two different dates, 2011 and 2013. And you can see that things can change drastically. It's gone down a little bit. It's gone down by almost 1%. Trading volume is way down. The range, right, has gone up a lot, right? Instead of in the high 20s, we're now in the mid to upper 30s. In the last year, it's gone down by $8.68. And your price per earnings has now skyrocketed to 25.6, which is actually a bad thing, right? A high PE ratio is not a good thing, which is what we talk about here, right? Which is better, an 8 or a 25.6? And it really all depends. But with a higher share price of 33.88, it's good if you own the stock. But the big question is, will it continue to go up? So like if you bought these shares a long time ago, it's great because hopefully it's gone up. But the question is, should I buy more now? And with the lower earnings per share, $1.32, right down here, earnings per share, it's not good. So it means the company's not making a lot of money. Now, historically, the stock market PE ratio hovers around 15, meaning people are normally willing to pay 15 times what a company earns, because that's what the PE ratio is. If it's 15, that's, the price is basically 15 times as much as the earnings. So they're willing to pay 15 times as much as they earned for that year to buy the stock. So when your PE ratio is up at 25%, you should be cautious in expecting the share price to go much higher. So high PE ratio is not good. Low PE ratio tends to be better, but it's not a hard, fast rule, right? Too low could also mean there are problems. And that's what the guys on Wall Street make all the money for, is figuring out how these things work. All right, so here's a little graph that kind of shows what we're talking about with the PE ratios in blue. You can see that for the most part, it really doesn't like to get above 20, right? It spikes and then it collapses, spikes and collapses, spikes and collapses. And if you look at this 20, it spends most of its time pretty much below 20. So 25, right? Our last one was 25.6. It's probably not a good idea. It's being stretched and it's most likely going to snap back, and that's when we have a problem. All right, some other things to think about are CPI, Consumer Price Index. What the heck is that, right? Well, the CPI, the Consumer Price Index, is basically a measure of the average change over time in the prices that you pay for goods and services. So they kind of have like a basic, you think of it like a basic shopping cart full of basic goods and services: milk, bread, eggs, the cost of a house, cost of a car, kind of just utility costs, all sorts of goods and services, how much it costs to get something fixed or something repaired, all those types of things. And they kind of come up with an average over time of how much that basket changes. Maybe milk went up, but bread went down, those types of things. And then what's the total sum? And that gives you your CPI. Inflation is just the idea, it's an economics idea, that it's this consistent, persistent, the same thing as consistent, right? It's consistent increase in the general price of goods and services over a period of time. Things always tend to cost more. So based on a CPI index, and in this case, your CPI index is a ratio, right? So it always has to be an index ratio compared to something. for these examples, it's going to be set to $100 for the cost of these goods and services in 1983 dollars. This is just an arbitrary setting. Different CPI settings, like people like to have CPIs set to 1980 or 1990, 2000. They tend to use those types of things. This one's 1983. So basically what we're doing is we're kind of considering a dollar in 1990 as being a completely different currency as one in 2013, because it really is worth a different amount in both of those 2 years, kind of like when we converted between dollars and euros. So according to this, $100 worth of stuff in 1983 cost $130.70 in 1990, and it cost $233 in 2013. So with that in mind, we can say, well, how much does a $6.50 item from 1990 cost in 2013? And here they're talking about $6.50 being a cost of a movie ticket. So if it costs you $6.50 to go to the movies in 1990, if you set up the ratio, right, and it's very simple, you just do 233 divided by 130 equals X over 6.5, and then do the math. You'll see that it costs you $11.59 today to go to the movies. So that's why they talk about Gone with the Wind being one of the highest grossing movies of all times, because when you convert the money that Gone with the Wind made into today's dollars because of that CPI index and the change in inflation, $100 back then is worth like $6,000 a day type of thing. So it inflates how much money was actually spent on that movie. All right, here's another example where they're looking at CPIs over some years. You guys can pause and take a read at that. The last thing we'll talk about is money ratios for retirement. And here's a fancy little table that kind of tells you how much money you should be saving each year and how much money you should have in retirement funds and blah, blah, depending on how old you are. So an example would be if you're 30 years old, we're looking at this row here, our capital income should be 0.6. And so let's say if you're making $50,000 a year, if you set up this ratio, you get $30,000. So you should, at this point, have saved $30,000, right? So if your yearly income is 50 and you're at age 30, that means you should have $30,000 in a retirement fund somewhere. And that retirement fund should be 50-50 stocks and bonds. Now, this is just one person's opinion. You can go on and see that you also should be saving 12% each year, or $6,000. Your mortgage shouldn't be more than twice your income, so you shouldn't owe more than $100,000 on your home. Your education earnings, i.e. your student loans, shouldn't be more than 0.45, 45% of your income, or $22,500. And down here at age 35, they're thinking you should have all of your student loans paid off, which we know is absolute lunacy for most people. So like I said, this is just one guy's opinion. And that's everything we need to know for financial literacy.